representing roles today. We wanted our firm to represent each one of us equally, so we chose the initials of our first names to come up with our company name. We had a bit of a rough start. Markstrat information overload. We were overwhelmed, unsure, and thought marketing was merely advertising. But we pulled together as a team, studied, researched, and kept going. As we learned how to function and make better decisions in the Markstrat environment, we recovered our losses and in the end increased our share price index from 686 in period 1 to 2,410 in period 6. We also increased our return on investment by almost 8%. As you can see in the graphs, we are leading the industry in both share price index and return on investment. Pretty good results for such a rocky beginning. When we look at how each brand performed, it is clear that we had two strong products that targeted very different segments, and one product that performed poorly in almost every segment. As we look at the market share represented in the graph, we see that at the end of period 6, Rock attained 84% professionals, 7% baby boomers, 12% Gen X, 1% millennials, 1% Gen Z. Because Rock was priced higher, it did not capture the price-aware baby boomers, millennials, or Gen Zs. At the end of period 6, Roar had 0% professionals, 4% baby boomers, 2% Gen X, 82% millennials, 10% Gen Z. It was designed to target millennials, so we were not surprised that we had 0% professionals and 82% millennials, as they have very different price appeals. Gen Z was also price aware, similar to our millennials, so we were able to capture 10% of that market with Roar. At the end of period 3, Roll continued to perform poorly and was withdrawn from the market in period 4. They only had 2% professionals, 7% baby boomers, 2% Gen X, 3% millennial, and 1% Gen Z. Because Rock was designed and marketed to target professionals who feel that higher price indicates higher value. And Roar was designed and marketed to target millennials who are very cost conscious. That's why there's a large discrepancy in our market share between our two products. How did our brands do? Well, Roar was our newest product that we designed to target the growing millennial market, as we've said before. We were very successful in this market, achieving roughly $220,000 in retail sales in period 6. 82% of those sales, no surprise, were from the millennial segment. Our total market share for Roar was 31%. Brand contribution after marketing expenses, $92,000. Rock was our long-term performer with almost $188,000 in sales. 84% of these sales from our targeted market professionals. Rock's total market share was 17%. Brand contribution, $73,000. Both of our products proved to be profitable in their targeted segments. Cumulative revenues and earnings were also very profitable, and hopefully will earn us a vacation. What lessons did we learn? Well, we learned by maintaining high brand awareness for Rock, we were able to continue to make a profit even when Roll was rapidly declining. We also, one of our keys to success, another key to our success, capturing growing segments. By designing Roar to align exactly with the ideal values of the growing millennial market, we were able to capture a new segment which proved to be very profitable. What would we do differently if we could go back and change something? Well, we would withdraw Roll sooner because it targeted the declining baby boomer segment. And even with advertising efforts in periods 1, 2, and 3, it continued on its downward descent. We would also launch Roar earlier, which would increase profits earlier in the initial periods. It would give us better performance. It would allow us to fund new products, maybe even to target the other growing segment, Gen Z. Another thing we learned, trust our calculated production numbers to prevent lost sales. Looking at our production volume, we realized that we really had to compare purchase intentions to our market share. If the purchase intention was higher than market share, this was an indication to increase production. So we did some calculations. We found that in period 6, we should produce 767,000 units of Roar. But we felt this was being overly optimistic, so we chose to be a little more conservative, and we only produced 640,000 units. Well, at the end of period 6, we lost an estimated 240,000 sales. So we did learn, trust those numbers. They're real numbers, and we could have actually been a bit more profitable. Segmentation and targeting. We found that it was critical to consider the growth or decline of our product's targeted segments. Keeping roll, again, was detrimental in periods 1, 2, and 3 since the baby boomer target was declining. On the other hand, we found adding a product targeted at the rapidly growing millennial skyrocketed our sales, market share, and revenues. As you can see in the graph, we dominated in the millennial market in the last period. We learned that using semantic scale studies to calculate characteristics of our new product Roar was a very easy way to capture a growing segment. We chose to align our characteristics almost exactly to the preferred values for the millennials. We also redesigned the already successful Rock to be more in line with the professional values and increased our market share of professionals from 35% in period 2 to 84% in period 6. Research was invaluable to the success of our company. Of course, aligning our product's characteristics with the values of our target segment was not the only way we increased our market share. We also placed and promoted our products effectively. We used perceptual objectives to not only increase awareness, but to change the buyer's idea of what those characteristics were. In other words, we did not have to invest in an R&D project to actually change the product. We were able to convince the buyers that our product already had all that they desired. We also set our digital marketing to exactly match the shopping habits of our targeted segment so that this investment was maximized. We used the shopping habits of professional for Rock and those of millennials for Roar. We found that the size of our sales force and commercial team had to match or beat those of our competitors to see increased sales and revenues. The sales force teams are those on the front lines promoting and selling our products. Price. Well, we found price was pretty important for our products. It could not be determined by production cost alone. It is critical to have enough research data showing competitors' pricing and the buyer's perception of price. It is not always necessary to have the lowest price in your market, as we learned with Rock. Rock had the highest price and still captured the largest percentage of its targeted professional market. Roar had to be priced competitively to appeal to millennials, but not too low. The profit margin had to be considered as well. So as a team, we survived, we succeeded. We're pretty proud of our success, but we did learn a lot. We know we could have made some changes to be even more profitable in the end. But now we understand there is so much more to marketing than just advertising. Markstrat was overwhelming, challenging, frustrating at times, but we feel that we learned much more than expected.